On January 3rd, 2022, the first trading day of the new year, Apple became the first US company to reach a market cap of 3 trillion USD. But is the company really worth that much? Let's go through it and talk about how you really can evaluate a company at the size and scale of Apple. And just to cover everything, I'm not a financial advisor, and this should not be taken as investment or financial advice. You might have read the headlines that Apple reached an unprecedented $3 trillion market cap, but for starters, what does that really mean? Quite simply, market cap is evaluated by multiplying the quantity of a company's shares by their value. For example, if Tet for Thought had 10 shares at a price of $10 each, Tet for Thought would have a market cap of $100. This now leads us into how a share's price is calculated. Once a company gets past its initial offering phase of shares, share prices are mostly driven by supply and demand. When a company issues more shares, oftentimes the quantity flood causes the prices per share to drop, but allows the opportunity for the company in the future to raise greater funds because of the new shares. The second primary driver is, of course, demand. When investors believe there is a lot of value in a company, the investors are willing to pay more per share and the price goes up. Unfortunately, shares in the greater market surrounding them can't be evaluated 100% quantitatively. There's a degree of subjectivity that comes into play, and it's within this subjective space where you can really debate the actual value of a company. For example, one such subjective metric is investors' confidence in a particular company. Especially in recent years, the stock market has been driven by investors' relative short to medium term confidence. For example, if investors were confident that Tet for Thought would perform well in the short to medium term, and performing well here can mean many things like growth, views, sales, etc., they would invest in shares for Tet for Thought, and the share's value would increase if Tet for Thought performed. The bottom line is that investor perception of a company plays a big role in the demand for a company's shares, which in turn has a direct effect on the price per share. So, Apple is worth $3 trillion, right? It just mathematically makes sense. If you evaluate their market cap, that should be the end of the story, right? Not really, because arguably market cap isn't the best or only way to evaluate a company. It's no secret the stock market fluctuates quite a bit, and on the same trading day Apple broke the coveted $3 trillion barrier, by the end of the day, Apple's share prices dropped ever so slightly to $182.01 per share, a bit below the daily high of $182.86 that had pushed it across the 3 trillion mark earlier in the day. So Apple closed out the day sitting just below 3 trillion, and at the time of writing, Apple's price per share has dipped a little bit, closing the previous trading day January 14th at $173.07 per share, which works out to a market cap of roughly $2.83 trillion, which is still an immense amount of money, but well below that $3 trillion landmark. It's because of these fluctuations in the market that going off of market cap alone isn't the greatest evaluator of a company's value. Granted, Apple is quite a bit less volatile than not only the market as a whole, but other tech sector stocks as well. We still just can't calculate market cap and call it a day. To get a better bearing on Apple's actual value, we have to return the space of subjectivity previously mentioned. Many historians and even some economists have claimed that the old Dutch East India Company from the 17th century was the most valuable, richest company in history. Stocks and shares didn't quite exist as we know them today, so it's actually hard to quantify things like market cap for the company. Hence, many analysts have had to delve into subjectivity. Some claim that you could actually evaluate market cap because the company did issue shares for investors to buy, and the total of these worked out to $7.8 trillion when adjusted for inflation. However, the system was quite different than today's stock markets, and the argument is a lot more nuanced than just adjusting for inflation and going from there. So, in my opinion, it's a bit of a false equivalency being made. Giving the Dutch East India Company a fair shot, evaluating things like influence, technology, intellectual property, growth, etc., all led to much better, more accurate evaluations of the company than just their 400-year-old market cap. Influence perhaps the most important, considering the Dutch East India Company had its own private military, but the same subjective evaluations can be applied to Apple and other companies today. Apple obviously succeeds in all the aforementioned areas. They're a technological powerhouse with incredibly valuable IP, especially in the mobile space. As much as I disagree with or don't prefer Apple's devices, these are all hard points to contend with, and I don't believe anyone could seriously argue against Apple being very advanced. As for growth, the proof can be seen in the value of their stock over time. Apple is remarkable for having very consistent, relatively slow but also very steady growth, and they are constantly beating their previous quarterly revenues, making more and more money year over year. This proven growth metric leads to higher investor confidence, which is evident in the steady growth of Apple's stock. Influence is a little bit bigger of the conversation to be had. It's no doubt that Apple is highly influential in its domestic market, the US, and given the current mentality of younger folk here, that trend seems like it will only be amplified in the years ahead. Apple isn't just influential and popular in the US, but also in other developed Western economies like Canada and the UK. However, their influence doesn't end in the West. Apple is fairly strong in highly developed Eastern economies as well, like Japan, the reasons for which are many and not really relevant to the scope of this video. The bottom line is that Apple is strong in the developed economies. However, Apple not only benefits from developed economies like Japan and the US, it's also notable that Apple has inroads into the two largest, most rapidly growing consumer economies, India and China. Apple has long played nice with the Chinese government, being in their good graces to be able to assemble iPhones and other devices in China, giving them access to cheap labor and higher profit margins, but also allowing for the sale of their devices in China, which, as the Chinese economy develops more and more, and the average Chinese has more disposable income, this places the sale of iPhones to increase in China, especially if Apple is able to maintain their brand of luxury associated with them. India is much the same. Apple has been slowly trying to transition the production of older model iPhones to assembly plants in India, and India's consumer economy will grow much the same way I've described for China. This obviously puts Apple in a very good spot, being in on the ground floor for taking off economies. However, there are some problems associated with this as well. In the Eastern Hemisphere, a more collective sense of consumer culture has been observed. This is perhaps caused by these economies growing up with such easy ways to communicate, and India and China are no exceptions. For example, when Nike referenced the Muslim genocide in China's Xinjiang province, Chinese consumers completely turned on the brand, literally overnight. If, say, tensions between the US and China get worse, or God forbid any sort of conflict were to break out, there's no doubt Apple and other US companies available in China would be vulnerable to this collective ostracization. It's important to keep the risks and benefits of foreign markets in mind when evaluating a multinational company like Apple. So with all this being said, what really is the value of Apple? Should it be higher or lower than $3 trillion? Well, my short answer is $3 trillion sounds about right. I know, kind of a cop-out, but let me explain. In today's day and age, it's much easier to gather information on a company you're going to invest in, as well as gain information on the risks associated with how the company operates. For example, it's no secret to investors that tensions between US and China might be on the higher side, and the risk that rocky relationship might pose to the tech sector as a whole, but for the short to medium term, as mentioned earlier, nothing seems like it's going to drastically change that would negatively impact a company like Apple. And Apple's sales show no sign of slowing down. Consumer interest is still incredibly high. The ability to access all this information and its subsequent evaluation all lead to high investor confidence in Apple. That is to say that because of how ubiquitous information is today, all the subjective factors I mentioned are priced into a company's stock. And while market cap isn't the be-all, end-all evaluator for a company, it's a much more accurate and fair metric than it used to be due to the market's heightened ability to price things in. And with that, let me know in the comments below. Do you think Apple is overvalued, undervalued, or just about right? Also, make sure to leave a like, subscribe if you aren't already, and hit that notification bell. We try to upload at least twice a week. And be sure to follow us on Twitter at tech_4_thought and Instagram at tech_FOR_thought. And also make sure to check out our podcast, Pass the Salt, recorded live every Saturday at 1 p.m. Arizona time. See you all in the next one. It's no secret the stock market fluctuates quite a bit, and on the same... What is going on?